Hej, välkommen till Börslunch på efn.se. Ja, vi har återigen lämnat våran studio och nu sitter vi här på DNBs kontor på Park Avenue i New York på 31:a våningen. Och jag har idag med mig Jim Cirenza och han är chef här på New York-kontoret. Welcome Jim, lovely to have you with us.
Good to be here and good to see you again.
It's been 2 days since elections and the market reactions have been very positive in some areas. How do you explain the market reactions so far?
First of all, the market surprise that we saw back in Brexit ended up being very short-lived for the equity markets. And we've had the same kind of experience here again, except the short-lived was less than 24 hours. It was just a matter of a few hours. If you look at how clients were positioned, institutional clients were positioned coming in, the sectors that they were long or the sectors they were underweight in were not right necessarily for the election outcome, but one thing they were overexposed to was cash. So clients came into this exposed, slightly overweight in terms of their fixed income exposure, slightly underweight in terms of their equity exposure, but they were sitting on the most cash that they have sat on since the fourth quarter of 2001. So too many people had a buy the dip mentality, and this time the dip was very brief.
Buy the dip. Something that strikes me is that the sectors that went well yesterday also continued to go well today. So is this a trend that you would want to follow going forward?
I believe so. And if you look at a steepening yield curve, and if you just go back 1 week ago, the 10-year yields in the U.S. are up almost 18%. The 30-year yields are up about 12% from where they were a week ago. So as you think about that steepening yield curve, and you think about where a U.S. bank, a U.S. regional bank, makes its money, it makes its money by borrowing short, lending long, and it also makes its money by, to a large extent, at least 50%, to its real estate exposure and housing exposure in terms of its lending. So as the curve steepened and as the U.S. housing market continues to heal year on year on year, those are great support mechanisms for the regional banks. You think about the infrastructure plays. Skanska had a big move yesterday. So you think about what is probable to come out of this and what could possibly happen in the first 100 days that would not be controversial. One of the things being discussed is a $500 billion, infrastructure plan for the United States. So how do you fund that? Well, maybe you fund part of it by putting a nominal tax on foreign cash reserves to bring them back to the U.S. So if you can put a 5 to 10% one-time tax on those to bring them back, you might be able to fund a third of your infrastructure plans. But the rest would clearly have to be funded through additional Treasury offerings. And so this notion of the curve getting steeper and bond yields going higher, but at the same time, what it means for economic growth, particularly for the U.S., but also for Nordic companies that fill the gap in terms of raw materials, construction, transportation, etc. Those themes are not two-day themes.
So these themes are all very positive. Do you see any negatives out of the election outcome?
If you were invested in Mexico, and I know some people who are, you've had a really bad 2 days so far. The Mexican peso has made an all-time low today.
And are those also themes that will continue, the negatives ones, like the peso?
I think those themes are going beyond my perception of what the reality will be going forward. Changing some of these trade deals would unlikely be part of an early agenda. You think about what a House and a Senate and a White House would push for in the early part of a term. So I think the market's getting ahead of itself in terms of the implications for the emerging markets. Also, beyond Mexico, I'm surprised the emerging markets have been as weak as they have been over the last 2 days because, on one hand, they're big beneficiaries of stronger raw material prices. You look at the way that metal prices have traded not only over the last 6 months, but particularly over the last 2 days. It's an incredible recovery in terms of iron ore, coal, aluminum. And then you look at oil prices, which dipped down temporarily yesterday, but have recovered since. Those are all the emerging countries, to a large extent, are beneficiaries of that.
So when you're talking to clients, what you're saying now is what seems to be the consensus, that infrastructure and stuff like that is going to go well. What are clients saying more? What are the worries out there?
The worries out there is a lot of what has been invested in the markets has been supported by central bank activity. Now we could have a Fed that tightens quicker than was previously planned. This infrastructure spend comes with some inflation component. And so does this trigger bond yields everywhere to move higher? Does this trigger central banks globally to be less accommodative? And so there clearly are scenarios you could point to, but what is being perceived as the consensus here is this is at least a pro-growth scenario, particularly for the U.S. and for the companies that supply those segments.
And talking about the U.S., some of what Trump has been saying is very protectionistic. Do you see that as a positive or a negative?
For the markets, it's always a negative. And that's what we're seeing, the initial reaction in the emerging markets. But once again, I think that has gone too far.
But on the other hand, it's also what will bring back money to the U.S. I mean, those steps that he's taking.
Well,
is hopefully will be taking.
Well, the key move in terms of funds is to bring back, those foreign cash reserves that have avoided coming back under full U.S. taxes. So whatever the level of tax holiday to return those funds to the U.S. for share buybacks, for dividends, for other corporate purposes, that's not a protectionist move. Changing trade agreements would be a protectionist move, but that by itself is not a protectionist move. And obviously, you think about the level of share buybacks and dividends that we've had over the past 2 years in this market. They've exceeded the level of new issuance by a substantial amount. And then you think about the investable cash. You think about the M&A activity that we've seen. We are about to have our 11th straight quarter of over $1 trillion of global M&A with a very large cash component. So from an investor's point of view, they can't sit still. They continually quarter after quarter continue to end up with a larger cash balance, and they need to invest. But once again, there's a big difference in terms of repatriating cash.
And talking about companies in the U.S., would you like to buy American stocks with a large exposure to the U.S. market, or could you as well buy like Skanska, who has an exposure to the U.S. market?
I see them both as being very similar, and you look at the footprint that a Skanska has in the U.S. and you look at the potential growth rate for them. That's a very interesting play. You think about the capital goods companies in Sweden. You think about the energy-related companies in Norway. You think about the metal companies between Sweden, Finland, and Norway. They're all beneficiaries of the developments we're talking about here.
And so what would you not buy at this point?
I wouldn't touch sovereign debt. I would be selective in terms of high yield investments. I would be cautious about investing in utilities, telecoms, and segments that are interest rate sensitive. And I would be a little skeptical of the rally that we're having in healthcare.
Why is that? That is also a big trend, isn't it?
It is a big trend, but to me that was a short-term trade. That was a trade where people went underweight due to an election outcome. I'm not convinced that the I'm not convinced that the election reality will change very much. That was a trade that people were afraid if Hillary got elected, healthcare was not going to work very well. I'm not convinced that that's anything more than a short-term trade.
But it is. I mean, they're not going to experience the same price pressure as you would expect otherwise with Hillary.
Probably not, but I question how quickly those price pressures would have occurred.
Another sector that has rallied is banks. And what type of banks would you own? You were talking about those local banks.
Yeah, listen, I think the regional banks are sitting in the best position because they benefit from all these domestic trends. You think about the infrastructure spending and you think about the need for those regional banks. You think about the employment situation in the U.S. going forward, and you translate that into what it means for the housing market here, and you translate that in terms of what it means for the P&Ls of these banks. If you go back to the financial crisis, we had over 10,000 regional banks with 50% of their exposure to the real estate market. And in the worst of all years, in 2010, the FDIC shut down 150 of those regional banks. We're now in a scenario where there are virtually no banks being closed. The number of regional banks is down to about 7,000. And the health of these banks is quite good. So you combine that with stronger housing fundamentals, a steeper yield curve, potentially more energy production in the U.S. again, and the infrastructure spending. And to me, those regional banks, and they've been on fire for the last 2 days, but those regional banks, to me, are headed for all-time highs. I also think it's a good environment for the large investment bank, global banks as well.
Because of less regulation, or?
Regulation has probably peaked, so that's one thing. They also benefit from a steeper yield curve, and there will be greater activity. There'll be greater capital markets activity, so they'll benefit in a few ways. But I like to leverage on the regional banks more than I like to leverage on the global banks.
You're head of a Nordic or a Norwegian, actually, firm. How would you describe the Norwegian market right now and the equities you find there? How are they?
Well, Norway is very tied to oil to a large extent. So even though that oil is not even back to half of its price of the summer of 2014, the Oslo All-Share Index is about to make another all-time high. The Norwegian economy held up much better than most people thought it would when oil collapsed, and the diversity of that economy is greater than most people had anticipated. So you look at what is performing really well in the market right now, and obviously Norsk Hydro, with aluminum prices strengthening, has performed well. Storebrand has performed very well. So DNB has performed very well. So you look at what is performing well in that market, and it's offsetting what has happened in the oil service, side. And so we are back to potentially making all-time highs here in that market as well.
So you're positive on the Norwegian market despite this all-time high. It's going to continue. You're working with selling Norwegian stocks to Americans. How do they react to the Norwegian market? Do they buy this?
People here don't look at the market as such as they look at the individual names. And so if you're an investor in the United States, you have global funds and international funds for the most part. Very different than if we were sitting in London, where I was yesterday, where they have a lot of European funds. So a U.S. investor, a U.S. value investor, doesn't have to own a Norwegian name. They don't have to own a Swedish name. So they don't view it at their exposure on a country level. They view their exposure of which industries do I want to be in and what's the best vehicle to play, regardless of where it is.
So they're stock pickers, and which are your best stock picks in the Nordic?
My best stock picks in the Nordic. I'll run you through a few of them, or a few segments. Even though the interest rate outlook isn't the same in the Nordic region as it is here in the U.S., I do think that the market has underestimated the value of the banks. I, in particular, like the Swedish banks at this point, and I think the market has underestimated its dividend capacity. Another name that we find very interesting is Statoil. We've come through what is probably the last of their messy quarters, and the free cash flow that they're going to be able to generate after they've done such an impressive job in the last year and a half of getting their break-even costs down. Statoil is going to become a cash flow and dividend machine going forward. So there's a handful of names in the Nordic region that we think will do quite well.
I wish you good luck with those names, and thank you for being with us, James.
Thank you.